Good afternoon, everyone, and welcome today on our workshop on Tax Hacks 2020. We have Mr. Amit Gupta from Dell Technologies, our guest panelist today, and he heads the payroll and taxation for Dell, Bangalore. And I'm Pratibha Sharma from HDFC Securities. I head NPS and corporate relationships for you. So, welcome, Amit, and thank you so much for taking out time today and joining us for Tax Hacks 2020. Very keen and very excited to have today's webinar with you.
Okay, great. Thank you, Pratibha. It's a privilege to be participating in this tax hacks. Just to correct one thing, I don't head payroll. I head just for the benefit of everyone. I head taxation for the Indian subcontinent for Dell Technologies. Okay, and very
I'm sorry
privileged.
for that.
No, it's okay. I just want to, because there would be people from Dell also on the call,
Yes,
and
yes, yes.
they may be no. So just for that, and very happy to talk about the topic today in terms of tax hacks. And just for the benefit of everyone, today we are actually focusing mainly on personal taxation, correct? Just for the benefit of
Yeah,
everyone, and that's why I think Pratibha was saying payroll, because it's mainly to do with
yes,
individuals and their taxation that we are trying to focus upon in this
yes,
next 1 hour. We'll sort of cover the content for about 45 minutes, 45 to 50 minutes, and then we'll take questions that the audience may have. Correct. So
yes,
so let's just move to the next page. And while we are doing that, as the heading is, don't just save tax and create wealth. Correct.
yes,
It's not only about tax that we are going to talk about, it's about creation of wealth. And what do we mean by when we talk about creation of wealth? So there are three aspects as I look at that we all have, correct? One is we have income. That's on the one side, correct? And then what do we do with that income? Now, there are three things that can happen with that income. One is you can save it, you can spend it, and a portion of it goes towards tax. Now, a lot of people equate, there are sayings which are there, correct? The death and taxes are the most certain things. Now, I don't like
yes,
equating taxes to death because I don't think it's as bad as death, correct? One should be happy that one is paying tax because you pay tax only when you have income, and one should be really
correct.
happy that you have income and hence you're paying tax. But does that mean you pay everything in tax or a big portion of your income in tax? No. One should look at planning, correct, in terms of options that one may have
Hmm.
in saving taxes, because the more you save, there's more that one can keep to oneself for expenses, for savings, and whatever. And in
Yes.
that context is what you see this page, correct?
Hmm.
Think medium to long term. Now, on the right side of the page, you see all the various kind of investments or expenses we will have. Now, before we get into it, I just want to sort of spend a minute or so in terms of saying, hey, when we are talking about tax hacks, we are talking mainly about two categories here, correct? The government
Yeah,
incentivizes certain kind of expenses and certain kind of savings, investments
right.
or savings, whatever you call that. So if you think about it, everything that's mentioned on this right side is either an expense or a savings or an investment opportunity. And there are various benefits that one gets. So for example, home loans, correct? There are home purchases. We do get tax benefits, correct, in terms of the home loans that are taken, or the interest
Right.
that's paid on the loans. Education, that's again an
Right.
expense, but there are deductions which are being provided. Um, then look at medical. There are many benefits that are provided on medical, like health
Correct.
insurance, life insurance, and all of it. We'll cover that as we move along.
Yeah.
But
Yeah.
really, the way I look at it on this page, and Pratibha, you can add on, but really the way I look at it is there are various categories, obviously short term, medium term, long term, and emergency. Emergency is something that you can never it's like something like a emergency fund that you have to keep with yourself, correct? For that you always
Correct.
say, hey, I will keep say 10% or 15% of my income, or 15% of or 10% of my savings as emergency fund, which I can liquidate. So liquidity becomes
Yes.
very important, correct? Especially
Yes.
in emergency. And that is where you have to think about the short term, medium, and long term, correct? That's why maybe
Correct.
keeping some amount of money in fixed deposits is a good option, which can be used towards it, even though fixed deposits are not lucrative at this point in time, correct?
Yes.
With
Yes.
the
Yes.
returns being really low, I think I
As low as
it's been
2.5%.
yeah, yeah, it's really like uh, putting money in FD can be like can actually work out to be, given the cost of inflation and all of it, it could actually
Yes.
yield negative returns in that
Yes.
context.
Yeah.
Short term, definitely car vacations and all. One has to look at. There are no tax benefits really on on buying a car. Uh,
Yeah. Yeah.
on vacation, but you can draw loans basically. I think that's the
Yes.
idea. You can always draw. Today you can fund anything. You can fund a vacation. Banks would be willing to fund your vacation depending upon your credit profile, home repairs, anything. And then medium to long term, one has to think about the cash flow, the liquidity for home purchase,
Yes.
education, family support, and all of it. Then obviously children's marriage, and then retirement, in my view, is one of the biggest things, and that's what we'll cover as we move along. We'll talk
Yes.
about NPS and all that, the national pension system, and all of it. So Pratibha, you want to add anything on this page?
So yeah, as you said that, looking at a medium term and a long term goal is quite important. So planning for taxation is not a overnight thing that I have an exam tomorrow and I sit and study. It is
Yeah.
something that we should start planning as early as possible so that we don't have those last minute glitches. And at the same time, we should be able to match it with our future requirements. So say 10 years down the line, if I need some corpus for my for education of my child or for buying a home, so in that case, how am in what kind of tax investment avenue am I going to make an investment so that that maturity of that investment helps me and supports me in education corpus, or in a corpus which helps me in buying a house. So it is always imperative that we try and match our requirements with the investments that we are going to make, and of course it gives us some tax benefit. That's quite important here.
Yes, absolutely. And liquidity, as you rightly said, I think liquidity and timing it, a lot of times we have to think about that, and with the benefit of tax, the maximum benefits that one can derive. Obviously, one should
Yes,
look at that. Yeah. Yep.
absolutely.
Hmm.
And with that we come to our tax hacks toolkit. So we have identified several avenues of making investment, which can actually help you align with your financial goals. So Amit, as you can see, I have mentioned ELSs, we have fixed deposits, we have health insurance, life insurance. EPF, PPF, sovereign gold bonds is one of the additions, and national pension system, of course, ultra long-term investment and ultra tax benefits, as we've been discussing about. And then we have tried to categorize this in terms of the nature of the investment. If we talk about ELSs, this is very much a equity oriented investment. And when we talk about a 5-year tax saving fixed deposit, this is more of a debt driven investment, a very vanilla investment here. So we can look at it one by one as we go forward.
Yeah,
But yeah,
yeah, sorry, go ahead.
yes, please. We can just look
Yeah,
at it one by one.
yeah, we will do that. I just wanted to add here that the asset classes where they are invested are also important, correct? The
Yes.
equity, bank deposits, government debt, and then we'll sort of go through it. I agree. So let's move to the next page, and we can cover that one by one.
Yeah, and so quickly we would like to have a look here on the tax regimes before we start in detail about all the investment avenues that we've been discussing. We would like to discuss on tax hacks today. So we all know that there are two tax regimes now. One is the older tax regime and one is a new tax regime which was introduced in the previous budget. So Amit, since you are an expert into this, we would like to have your opinions and your inputs as which one would you recommend or which one is a preferable tax regime here in terms of what would you think that which one is the tax regime which a person should go ahead with and why?
Yeah, no, no. So this is one of the most important questions. I can tell you that most of the people have had since the time this new regime has been, which is optional. So I have to state that it is optional. So one can choose either to stay in the old one or go with the new one. Okay. Now,
Right,
when it is
right.
said optional, how does one choose? What's the
Hmm.
way to choose it? The way to look at it is you already know how much you earn, correct? You have to look at
Hmm.
your
Hmm.
income. One should look at what are the exemptions which are going away under the new regime. Frankly, under the new regime, if I am not wrong, actually about 70 exemptions or 70 deductions have been taken away, almost
Hmm.
70. What's really left, in my view, under the new regime is really the 80CCD2, which is the
Yeah.
NPS, where the employer contribution, which is 10% of the salary, I think that's the only one which remains, which is meaty enough. Rest, I maybe few of the other ones may remain, but
Hmm.
uh, as far as I recall, even 80C is gone away under the new regime. So frankly, one would have to look at uh, how much is your income. Now it all depends upon the bracket. As you can see on the right side on the table, one would have to do a calculation of these various slabs which have come in as to under which income bracket one falls. Are you in the 10 to 12 or 12.5 to 15 or 15 plus? Do a math of that as to the
Hmm.
new rate without any exemptions, almost everything taken away or deductions, and what's really left is the 80CCD2.
Hmm.
Look at that, compare that with the other. Now, if you see a lot of these incentives which were there, which are there in the old regime, don't stay in the new regime, which is like, for example, the
Right.
transport related deductions, the medical insurance, the house rent, education, donation, home loans. Now, even home loans, if you know the 2 lakh, the deduction that normally people take for the home loans, the interest on
Hmm.
the, even that's been taken away, provided it's a self-occupied property. I have to say that. If it's
Hmm.
a rented property, you still continue to get that deduction on the interest that you pay on house
Right.
property. But if it's
Right.
self-occupied, deduction has been taken away under the new regime. So one would have to put all that into context. The other point that I have to say is that the old regime really incentivizes people to save, or
Yes, yes,
incentivizes expenses. As I was saying earlier, really from a government perspective, two things are being incentivized: expenditure on specific items and savings or investments in specific products.
right.
Um, those are being incentivized, and that continue under the old regime. Frankly, in my view, the old regime is more. I would say I would tend to prefer that, because yes, in the new regime you may be saving few thousands in taxes, but could be depending upon the profile of a person. But then your savings may not happen, and and
Hmm, hmm,
and if you are somebody in the age group of say 25 to 30 or early 30s, this is the time to start.
right.
One needs to start investing now, because one would reap the benefits really as you reach towards 60 and all, and that time the corpus you will have would be amazing, would be really
Yes,
something that
yes.
you can look forward to. And so start early, even though you may be under the new regime few thousand rupees may be better in terms of
Hmm,
overall taxes. I
hmm,
would still encourage people to stay in the old regime and keep on investing.
yes.
And or even if you opt for the new regime, do invest. Don't give up savings or investing in a lot of the products we'll be talking about in the next few pages. One needs
Yeah.
to continue to do that. Would you agree, Pratibha? What's your thought on this?
Yes, Amit, I completely agree on this. It's very important that we continue that habit of savings, you
Yeah,
know, that habit which has been actually incentivized, as you mentioned earlier. So, as always said, that, every drop makes an ocean. So, starting now, I'm sure, when it's time for maturity after 25, 27, or 30 years for that matter, it is going to be an enormous corpus which can be used for multiple purposes. So,
yeah,
and something which that corpus has actually reaped you a benefit on taxation as well. So that's how
correct.
we always end up saying that, don't just end up saving taxes, but also create wealth over a period of time. So going
Correct.
with the older regime, yeah, absolutely, a win-win situation for you. It not only gives you tax benefits, but you have a savings habit. You
Yeah,
have a habit of, saving on a monthly basis or on an yearly basis, and also create a wealth over a period of time.
absolutely.
Yeah, yes.
Okay, good. So
With
should
this,
we
I
start
come to
covering the? Yeah, yeah. Go ahead.
ELSS.
Yeah. So yeah, ELSS is a diversified mutual fund. I think I'll not read through the entire thing, but about 80% is invested in equity, is subject to, that's the caveat, subject to market risk, obviously.
Yes,
Yeah,
yes.
lock-in period is 3 years. Now that's something, again, the liquidity factor one has to look at, the medium term, the short term, long term, and all of it, and then decide.
Hmm,
But
hmm.
the amount which is invested is part of the ATC umbrella, the 1.5
Right,
lakhs. It's one
right,
of the components in the 1.5 lakhs. So you'll have to look at your
right.
overall portfolio and all of it, your
Hmm,
EPF
hmm,
and FPS and all of that. And
hmm.
income, this is the best part. The income, which is the profits on redemption, is tax free, up to 1
Yes,
lakh. This is the best part, I would say. So it's always good to invest a certain amount in this and keep it as part of your diversified portfolio, and
yes.
then think about it. And that's what's mentioned here, the EEE category, which is like exempt at the time of
Correct.
investment, exempt at the time of when you keep on accruing income against it, and exempt at the time of maturity or when you redeem it. So,
Hmm, hmm.
so, so it's really the investment is exempt, the accrual is exempt, and even the redemption or the encashment is exempt. So that's the it's quite a good one, I would say,
Yeah,
and
yeah.
one can look at having it in the portfolio.
Yes, absolutely. And if you also have to look at it, since it has a lock-in period of 3 years, but since it is a equity oriented investment, if you have to keep it for a longer duration, not just take a redemption at the end of 3 years, but if you look at it for keeping it for 5 years, 10 years, or 20 years also for that matter, being a equity oriented investment, it actually gives you an exponential return. It has
Yeah,
been observed and it has been seen that equity always gives you a very high return over a period of time if it is
yeah,
retained, or if you stay invested with it for a very long period of time. So
absolutely,
don't just we cannot just look at it to redeem it only because it has a lock-in of 3 years, but we can also look at it as a long-term investment,
absolutely,
which
absolutely.
continues to give you tax benefits. Yeah.
Which is the last point here, correct? Prepare for the long haul on the point.
Yes, yes,
Yes, yes.
yes. So
Okay.
with this, I come to a completely opposite investment option, that's tax saving fixed deposit, a traditional and a old aged investment, which normally everybody in our families have traditionally invested. I would say that, majority of us must have had some or the other tax saving fixed deposits in the family.
Yeah, yeah. No, absolutely, absolutely. And it's part of the ATC, correct? The investment
Yeah.
is part of the ATC. The only thing is that the interest rates are not really attractive as of now. I think
Yes.
the only thing is from a safety perspective, it's good. You get a you get a guaranteed return, which is the best part of it, which is what mentioned here. And
Hmm.
but the interest is taxable, so it's not EEE really. It is
Yes.
taxable. The interest that one would receive is taxable until and unless you are in a depending upon your taxability profile, until and unless
Hmm.
you are eligible for a 50G or a 15H and all of that.
Hmm. 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 So it's the growth or the accrual on your corpus is
Hmm.
taxable. So
Yes,
I would say what we rightly understand, or probably correct me if I'm wrong, only the investment to an extent of 1,50,000 is exempted.
correct,
The
correct,
accrual and the withdrawal is taxed.
correct, correct. You are
Yeah. So
absolutely
your
right.
yeah.
You're
So funds stay locked for 5 years, and
yeah.
whenever you take the maturity, it's taxed.
Yes. Yeah. So it's more of like sort of incentivizing again, as I said, incentivizing people to save. Now, it's like a choice given. Either you put in an equity-driven instrument or in a debt-driven, which is this is debt. So a choice has been
Yeah.
given, and similar treatment in a way that you get a deduction at the time of the investment, but as and when the when you get the interest, that's taxable, really. So
Right.
that's
Right.
what this is all about. Yep.
Would you still recommend audience to invest in tax saving FDs?
Frankly, in my view, it doesn't help. You get the ATC, so you've got the ATC, the
Yeah.
interest remains taxable. So until and unless you are not able to complete that 1.5 lakh through any other thing, and you are willing to lock in your money for 5 years,
Hmm.
again,
Hmm.
one has to keep in mind the lock-in of 5 years. I think there are many better. We'll cover the other ones. I think there are many more better investment options compared to this one.
Absolutely.
So, in my view, frankly, I have not put my money in this. So I would not recommend. If you ask me for a recommendation, I would say no. But again, it depends upon each individual. Correct? It's their choice.
Right. Right. So we can always keep tax saving FDs as a last resort. If
Yeah.
I'm not finding any other investment, I can blindly put in some money in tax saving FDs.
Yeah. Yeah.
Okay.
And
With
then
that,
a lot
I
of
come.
times. And sorry, just to add, a lot of times people would be
Yeah.
using this. Maybe you have already reached on 30th March, and you have to
Yes.
do something to meet your ATC number, correct? Now that's the
Yes.
easiest because you can just go online, immediately click on, go to any bank's website. You can immediately do this. It takes like
Yes.
few minutes to just do it. So maybe this could be the last option that one may. It's like you already, as I said, on 30th March or 31st March, you have to provide proof or whatever, and
Hmm.
something you
Hmm.
have to do. Maybe people would have done that just to meet
Yes.
that
Yes.
number. Yeah,
The last minute instant investment.
yeah, yeah,
Yeah. So with this, I come to health insurance. So
yeah.
I think, Amit, health insurance is something that, irrespective whether it gives you a tax benefit or not, you should always have one. Uh, Given that the kind of lifestyle all of us are living and all of us are leading to, we come across life-threatening disease every now and then. Cancer and all have become so common that, but cancer continues to be an expensive treatment, and it has been so common that, out of say 50, you always find two or three patients coming up. So irrespective whether you take a tax benefit or not, you should always have a health cover for yourself and your family members.
Yeah, I'll just mention about the thought process. A lot of employees and a lot of people go through it, individuals and all go through is that, hey, I'm already covered under the corporate insurance,
Yes.
the group
Yeah.
cover. So why do I need to take it again as
Yeah.
an individual on my own and all of it? So the way I look at it is one needs to look at so there could be elements that may not be covered in a corporate insurance. So I'll give you an example. One of my relatives, he was working in one of the companies. I will not name it. He went through a
Hmm.
certain surgery.
Hmm.
Now, the beauty of it was that he thought I'll be covered. He had intimated his employer and they had intimated the insurance company and all of it. They went through the normal process, and everybody was under the assumption that the entire amount will be covered because it was well below the overall cap. There's normally a
Hmm.
cap, but the total amount spent was within the cap. The assumption was, hey, I'll get everything. On the date of
Right.
discharge, when he was getting out, he was told only 20,000 will be paid, will be covered by the insurance company. And the total bill was about 1.5 lakhs. So, so there were exceptions. The point I'm trying to get to is one needs to look at exceptions which are there. Now, obviously, it
Right.
could be good to think about, hey, I'm covered under my corporate policy, but one has to be careful about the exceptions. There are
Hmm.
many exceptions and all of it that one can look at. So that is why an health insurance, which could will be good enough if one opts for it and takes it for yourself and for your family members and all of
Hmm.
it.
Hmm.
And then when you
Hmm.
start young, the premiums are low. I think
Yes.
that's the most important part. When you start young, the premiums continue to be remain quite
Right.
reasonable. And on
Yeah.
top of it, you get the deduction, which is what the important thing is, 80D. Otherwise, it just goes waste if you don't
Hmm.
do it.
Hmm.
And then you are the tax benefits are really the one that one should think about. And then who knows, as you said, when it can come into use.
Yes. Absolutely. Very important. Very important. I wouldn't call it an investment or an expense, but it comes actually under the headroom or head of emergency funds,
Emergency.
and it is
Yes.
very important that you should always be ready for something which you are not sure is coming or not, but you should be ready about it. So,
And that's yeah, that's the point, correct? The indirect impact on your savings that of
yes.
preventing large image. Yeah, yeah,
Yes,
yeah.
yes.
But
So even if you are, we would. Amit, I'm sure you would agree to this, that we strongly recommend that you have a cover for yourself and for your family members and for your parents also. Even if you are covered by your employer, take a top-up plan. Top-up plans are mostly not that expensive. Uh,
Yep.
Something which suits your pockets, suit everyone's pockets, and always comes handy in an emergency situation. Right, Amit?
Abs- yeah, absolutely. Totally agree.
Yeah.
Yep.
Yeah. And with this, I come to another insurance category, that's life insurance and ULIPS. Again, I would say that this is going to be a mix of tax saving, long-term investments, emergency fund, as well as protection. So this is like a basket of all in one.
No, absolutely. I think, yeah, as it's already mentioned here, correct? It can be
Yeah,
either a
yeah,
pure protection, a term plan, endowment plan, a ULIP protection
right.
plus savings. I personally like the protection plus savings
Yes,
kind of a thing, correct? Because you get market linked returns plus you are getting protection. So the emergency kind of thing, I think that's,
absolutely.
and again, when you start early, it's really beneficial. And
Yes,
the ATCC is there, and it's under the EEE, which where it comes, correct? This also comes under the EE, which is the exempt category. So quite a good avenue. ATC again within the 1.5 lakhs total umbrella, it has to come in, and one will have to look at. The lock-in period again varies, correct? It is 5 years for ULIPs, which is mentioned here, and it can be a mix of equity and debt and all of it. So it's quite a
yes,
very good. The point here is protection plus savings, really. Yeah.
absolutely. And as we mentioned for health insurance, I think we'll agree on this again that irrespective whether you're taking a tax benefit or not, have this for your protection, for your
Yeah.
future. Very important. I would say that don't think it as a tax saving option or an investment option. Always have this in your portfolio from an emergency fund uh, for an emergency fund perspective or for a
Yep.
future corpus perspective. Don't think of it as a tax saving avenue as such.
Yep. Agree.
So with this, yeah, yes, yes, please.
No, no, I'm saying I agree. Let's move to the next one then.
Yeah. Yeah, so we have this very old, very traditional, and our own PPF and EPF. So, Amit, I leave this one completely onto you because this is your forte.
No, no, this is PPF is something I really like. Frankly, who gets 7%, 7.1%, 7.2? It used to be 7.5, even 8 earlier. Now it's come down to, I think, 7.1. But even
Yes. Yeah.
7.1 is without any tax. So if you sort of add some kind of tax to it, the return really is even more than 7.1, because in every other place, so you put it in an FD, you'll end up paying more than that. So frankly, if you were asking me, would I suggest anyone to invest in the tax saving FD? No, not at all. If one really wants to go into a debt thing, go for PPF. The only downside
Right.
is that there's a lock-in of 15 years,
Hmm.
but if one is not in a big rush, or one can manage cash, this is the best option in my view, as compared to a FD. Now, again, the tax saving FD is 5 years, but really it's taxable. This is fully tax free, and the investment
Right.
itself is. So this is the EEE, really, correct,
Yes.
which is there,
Yes.
and one of the best. I frankly believe no matter, even if you, I would suggest people, even if you're already exhausted your 1.5 lakhs, still open a PPF, because the
Yes.
7.1% that you get, so you can still invest 1.5 lakhs provided you the cash flow and all you can manage. I would still
Hmm.
recommend people to put in this 1.5 lakh every year into a PPF account, so that you
Right.
get this 7.1% totally tax free. And
Absolutely.
then you can keep on extending by another 5 years as and when you want. And the government
Hmm.
allows
Hmm.
that 5 year at a time you can keep on extending it. So really one
Correct.
of the best.
So
EPF,
ultra
I
long
think,
term,
yeah, go ahead. Sorry,
ultra
go
long
ahead.
term, ultra long term
Ultra,
investment. And I
yeah,
think it also gives you an option to take some partial withdrawals in between in case of an emergency, or in
yeah,
case of a medical emergency and so on. So you still have an option to withdraw some part of it,
yeah, some
but
part of
it
it.
continues to be a long-term commitment. You have to stay invested for 15
Yeah,
years.
yeah. And then EPF, Employee Provident Fund, I think we are all aware of it. Long-term savings,
Yes,
guaranteed returns, current interest rate. There was so much discussion. Every day there's something in the news. When is the interest getting credited? It's not yet been credited. People have been waiting for. Finally, will it be in two tranches, one tranches? We heard the new year, it was decided that it will
right.
be credited at one go, 8.5%. It's really good. Who pays 8.5% and that too tax free? It's really one of the, I frankly, one of the best avenues, correct, that one can have, with the investment being exempt at or the money which is under again the ATC umbrella 1.5 lakhs, the interest is exempt. Again, the EEE category, until and
Hmm,
unless
hmm, hmm.
now the amendment has happened, until and unless you are the contributions are above 7.5 lakhs per annum. Uh,
Right.
Before the high income category, that it's now been brought under the taxable, partially taxable scheme, but beyond that,
Yeah,
but below that, it's all fully EEE. I just wanted to
correct.
clarify that point, that slight amendment has happened, that 7.5 lakh thing has come in. So yeah,
Yeah.
yeah,
Yes. So fantastic. On We are good to go with PPF and EPF. And with this, I come to sovereign gold bonds. Um,
this one I'll quickly sort of cover, Pratibha. So these are government securities denominated in grams of gold. Somebody who just wants to invest in gold, not for making jewelry, but just for uh, just for enjoying the appreciation in the price of gold, which has happened like amazing,
right.
correct? Somewhere I read
Right.
28 and 30% appreciation has happened, amazing, correct? So
Yes.
really gold appreciates when everything goes down. That's how we look at it. So it's kind of a hedge
Yes.
that one can have when we are looking at a diversified portfolio, trying to, hey, I put too much into the market and I need to balance it out, have a diversified portfolio. This can be a very good option. Why? The
Hmm.
biggest benefit that I see in this is two things. The first
Hmm.
one, the entire capital gain at the end of 8 years is exempt
Hmm. Yeah.
if held till maturity. So it's an 8 year bond. At the end of 8 years, you don't pay anything. So if you're
Hmm.
talking about tax hack, that's one of the best. 8 years, get the appreciation of gold. No need to hold it physically. Just have a piece of paper, or you can even demat it. One can
Yes.
even trade it actually. I think they
Yeah.
were now been allowed to be traded also in the secondary market.
Yes.
So if you
Yes.
are in need of liquidity, you can trade it. The only thing is, if you trade it, you may not get the capital gains benefit. That's the
Yeah.
only downside. But you can get the liquidity if you want. And at the end of 5 years, also you can, I think, you can redeem it. There is an option
Hmm.
that I
Hmm.
think the bond gives at the end of 5 years. The
Yes.
other thing is
Yes.
you get an interest of 2.5% every year. It's like
Yes.
if you just own physical gold, nobody pays you interest. Nobody.
Correct.
So it's like you're getting the savings interest. It's like money put into a savings bank account. You continue to get almost what savings banks are giving now. Savings in the account, I think, is
Yes.
2.5%, 3%
Two
now.
and a
I
half
think that's
percent. Yeah, correct.
so you are getting a savings account interest, though it's taxable. That interest is taxable. Capital gains is not. I think it's something one can think of if you're looking at a diversified portfolio, especially in terms of the hedge. As I said, when the market goes down, think about it. When the Sensex was 27,000, gold was still like 45, 50 or something, if I'm not wrong.
Yes, correct.
So so there's something to think about. Yeah. Yeah, go ahead,
Yes,
Pratibha.
something that something that as you mentioned earlier, if you are not looking to have gold in form of jewelry, a form of gold in a way of investment, a long-term investment, a short-term investment, if you want to trade it at a later stage, something that will help you in something that will help you in always having a appreciated value.
Yes.
So whenever you are redeeming it, I'm sure you will redeem it at a higher price than what you had invested, for sure. This is not something that will reap in loss at any point in time.
Should not, though, but
Yes.
yeah, yeah. Mhm. Okay, let's now move to the favorite topic, correct? NPS. That's
Yes.
your that's your forte actually.
Yeah.
No, but I can start with it and you can add Pratibha. But really, I think this is one of the I would say I don't know whether a lot of people have already opted for it or not, but the more I have looked at it and I have when I read about it, and I think it's sort of maybe a bit underrated, but I think this is one of the really good schemes that we have, not only from a tax perspective, but from a long-term retirement benefit perspective. As you can see, there is an accumulation compounding till age 60. I think at age 60, we'll
Yes.
talk about what happens. There is a low cost fund management fee. Now, this is
Yes.
like really one of the lowest. I've never seen
Yes.
0.01%. Never seen like that. In any of the mutual funds or anything, you will never see something as low as this. It is on maturity, one can take out 60% of the corpus
Yes.
tax. Even partial
Yes.
withdrawals are allowed, correct? And
Yes.
those are also
Yes.
exempt. I think the asset mix can be chosen by the investor, by the person who's investing, correct? And you can, depending upon how you want to, but one can look at a 75-25, and it can be changed. Um, the
Yes.
returns have been decent, correct? Um,
Yes.
mentioned here. You want to talk about how's been the return, Pratibha? Go ahead.
I would want to start with
I think we lost you, Pratibha, but in the interest of, I'll continue. Um, I hope I've not lost everyone, but I'll continue to cover this. So what we have in terms of the asset mix here is really that one can look at a 75-25 ratio and all of it. And while we are waiting for Pratibha, let me spend a few minutes to talk about this NPS. So NPS really is the national pension system, which allows two kinds of contributions. Correct? One, it could be what's called as voluntary, and one is what could be a mandatory or a tier one contribution. Now, as part of tier one contribution, also it could be a mix of Yeah. So can we move to the next page, if where we can talk about the. Yeah, Pratibha, I think you're back. We lost you earlier.
Yeah. There's a sudden power failure, so my network got
It's
disturbed.
okay. I think
So
you were talking about the returns, giving an idea of the returns that one has seen in the earlier page and the bottom of the earlier page.
yes, absolutely. So if you have to look at it at a long term, for a long term, equity has actually given a return as good as 12% over a period of 10 years. You see,
Mhm.
and same as for corporate bonds and government bonds, they have given you a return within a range of 8% to 9.5%. So the investment that a pension fund manager does over here. So if I have to talk to you about equities, there are predefined guidelines which are given by PFRDA here. So it is invested into software companies and into BFSI. The majority of the investment has to go into these two categories. And of course, oil and gas. So if you have to look at the composition or the proposition which has been made by a pension fund manager here, you see the stocks that has been invested in is companies like HDFC Bank, ICICI Bank, SBI Bank, Infosys, TCS, HCL Technologies, and ONGC. So these are some large cap companies, or I would say some blue chip companies, for benefit of the audience understanding. So this is where the funds are invested, and it is invested for a horizon of at least 20 years plus. So even if you have a look at the corporate bond funds and the government bond funds, the money is invested into long-term debentures, which has a maturity over a period of 15 years, 20 years, and so on. Okay, so look at the kind of returns it's giving you over a period of 5 years or 10 years. It ranges between 8% to 12%. And the kind of returns that you will see over a period of time with the kind of growing economy that we are seeing, I'm sure it is going to be absolutely phenomenal, Amit.
Yep. I agree. I agree.
Yes.
Okay, let's talk about the tax benefits on the next page.
Yeah.
Yeah, so let me take this one, and then you can add. So really the
Yes.
contributions, I was talking about the voluntary and the employer contributions.
Right.
Basically, voluntary is really what you contribute, and you get you get the 1.5 lakhs, and on top of it you get 50,000. So it would be 1.5
Right.
plus 50,000. It will become 2 lakhs. So that's 50,000 is the additional which you don't get anywhere else really. So 50,000
Correct.
is the additional, and then the employer contribution, which is uh, so the way it works is you can tie up under what's called as the corporate program, and then under that the employer will contribute up to 10% of your salary, and it's
Hmm. Hmm.
beyond rupees 2 lakhs under 80cc D2,
Hmm.
and the cap is up to 7.5 lakhs. So just for the benefit of
Correct.
everyone, these are not absolute tax numbers. These are the amounts that are invested or the amounts that are contributed. On this, your tax rate will apply whichever slab you are in, and that would be your tax
Hmm.
benefit. So if you are in a 30% tax bracket, then the tax benefit would be even more, correct? And if one is in
Correct.
a 10% or 20%. So think about it. Actually, whichever tax bracket you may be in, this is something to think about
Hmm.
and will really be helpful. So
Absolutely. Absolutely.
one can extend the benefit up to 7.5 lakhs actually. And so that's the, I would say, the beauty of it actually. And then
Yes.
obviously, just
Absolutely.
to add, there is no limit to the contributions under NPS. You can contribute even more. These are just the tax exemptions that or the tax benefits we are talking about, the tax deductions really. But one can contribute even more. Correct, Pratibha? You can even
Yeah.
contribute more if you want.
Yes, absolutely, Amit. So if I have to put it in this way, I am given a bucket of 1,50,000 to make investments under ATC. So I make investments in say PPF, I take ELSs, I take some ULIP, and I exhaust my bucket of ATC.
Yeah, yeah,
After that, I still have a little headroom wherein I can invest in NPS to an extent of 50,000 or more, and I can avail a tax benefit under ATC-CD 1B.
yeah.
That will be an addition to my ATC. Okay,
Correct,
so
correct.
here I end up taking a tax benefit of up to 2 lakh rupees on making investments. Plus, if my employer is offering me a NPS contribution, I can make a contribution from my monthly salary, that would be 10% of my basic, and take an additional tax benefit of 7,50,000, which is going to be over and above the 2 lakhs of the basket which I have used.
Yep,
So
yep,
it's actually a benefit of 9,50,000, Amit. And then,
yep,
but the
yep.
only thing the employee or the subscriber has to understand here is the 7,50,000 is a aggregate of my EPF, my NPS, and my superannuation fund. So if I have exhausted my 1,50,000 of EPF in ATC, I still have a headroom of 6 lakh rupees, which I can use, and that investment is further helping me to save some extra taxes.
Yeah, that is why I was coming because that is why I was saying overall 7.5 because you have to take into
Yes,
account all the other things. So that is why I was sort of saying overall one could end up being around 7.5 is what was
yes,
the point.
yes,
Uh, yeah, all depends upon facts, correct? One will have to look at each of your numbers and all of that. Yeah. But the point was that
yes,
contributions can be even beyond this if one would want, but with no tax benefits really, at the time of the
yes, yes.
correct.
Yes. So eventually, as we've been discussing that this is a very long-term kind of an investment. So it does gives you an exceptional tax benefits, but also look at it as a long-term investment, which will actually reap out great benefits since you have been given an option to invest 75% of your investment in equities. So if you are investing 100 rupees, you can invest 75 of it in equities and 25 of it can go into a government bond or a corporate bond. So think of the growth or think of the accumulation which is going to happen over a period of time.
Yeah,
So of course, that's the reason it is a pension product, a pension avenue, which and to promote it more, it gives you these exceptional tax benefits, I would say. So
absolutely.
I think everybody should go for this kind of an investment. Nobody gives you a tax benefit over and
Definitely.
above ATC and all the ones that we both have been discussing so far. It's only NPS which gives you benefits over and above ATC. So it's a no-brainer. I would say that everybody in the audience should go for it.
No, and just to add, the employer contribution mentioned here is actually will be part of your CTC. It's not
Yes.
like the employer will contribute, just so that I clarify. Employer
Yeah.
will not contribute anything more beyond the CTC. It has to be, it's like how you structure your CTC. This is one of the options given, whereas a part of
Yes.
your CTC is taken and contributed by the employer directly into the
Hmm.
NPS.
Hmm.
Again, it's like
Yes.
encouraging savings, investment, and all of it.
Yeah. Correct. But
From a
save
retirement
save
perspective.
money,
Yeah,
save taxes. Yeah.
yeah,
Yeah.
yeah.
So with this, I think Amit, we come to an end to everything that we had to offer from a point of view that all the avenues of saving taxes, all the avenues which helps you create a wealth over a period of time. And I would like to take a couple of minutes here to convince the audience on why they should go ahead and make investments with HDFC Securities is so if you have to look at it from an NPS point of view, I would say it takes only 10 minutes to open an NPS account with HDFC Securities. It is a completely paperless and digital process. You need not send us forms and KYC documents at all. It's a completely online process. You just have to upload your documents, and within 10 minutes, you have your account number in hand. Apart from that, HDFC Securities also helps you in making 360-degree investments into all possible financial instruments that are available, be it equities, be it mutual funds, be it any kind of debt funds, debentures, and so on. HDFC Securities has a very good research team that helps you taking calls every now and then. And of course, we are merely a call away if you would want to make any investments as such. So that was about us. And with this, we would like to take questions. There is a question mark icon over here wherein you can punch in your questions and ask us. Shyam, if you can help us with the question panel. Shyam, are you there? Can you help us with the question panel? We are not able to see it.
Just a minute.
Yeah.
Pratibha, you
So
got
I'll
that?
take a few of them. Yes, I am able to see it. Amit, I'll take a few of them.
Yeah,
A
let's do that.
question
Yeah.
from Mr. Vikash. He is asking, what about yearly fixed deposits? Is it taxable?
Yes, fixed deposits are always taxable. Only thing is the tax saving fixed deposit, the 5 year,
Hmm.
the
Hmm.
investment, the principal amount comes under ATC, the 1.5
Hmm.
lakhs. But the normal
Hmm.
fixed deposits are the interest is fully taxable. Even the tax saving FD the interest is taxable.
Right. Okay. Mr. Gyanendra Sharma is asking, what is the best way to keep some liquidity amount for emergency, but at the same time we get some extra tax benefits? RD is a good option, but we can't get any tax benefit. So is there any way as well? So I think he's
See,
trying to make a comparison between FD and RD, is it?
yeah, recurring deposit is nothing but like instead of booking an FD yourself every month, you just give an instruction to the bank, correct, to take like 10,000, say for example, 10,000 rupees every month and put it into an FD. Correct? I think that's when there's no
Hmm.
tax benefit of recurring deposits. On
Hmm.
your question is more on liquidity and I can, if I can be liquid at the same time get tax benefits.
Hmm.
Most of the tax saving instruments, if you see investments, savings options, not expenses, I'm not talking about expenses, the savings options really come up with some lock-in. Though, as we said, like for example,
Hmm.
PPF, you can withdraw some part of the money for some emergency
Hmm.
and all of it. You can, but I think there are specified things which are mentioned under each of the schemes. Even under EPF, you can
Hmm.
withdraw some part of the employee provident fund. Even as part of the employee provident
Hmm.
fund, actually one can make voluntary contributions. Even NPS, you can make
Correct.
voluntary
Yeah.
contribution and you can withdraw it. I think 25% is allowed. Correct me if I'm wrong, Pratibha. Even under NPS, one can withdraw
Yes.
25% of the corporate.
Yes. Yes.
And
25% can be withdrawn, and that is going to be exempted from tax.
yeah, and so there are various. One will have to look at the number of years of lock-in, and then how much withdrawal is allowed and all, and plan it all together. But yes, if you are looking at immediate liquidity, FDs are the best, definitely. But yeah, there are
Yes.
many, as we said, NPS is a good option, EPF, PPF. Though they come up with some lock-in, one will have to look at those minimum lock-in and all of it and plan accordingly. You want to add
Fair.
anything, Pratibha, to this?
No, I think you have explained this quite well, and I'm sure Mr. Sharma would have been convinced there.
Yeah.
So with this, I come to Mr. Ramanna Reddy. He's asking, I have opted for NPS already, which is 10% of my basic. Could I able to add more to my existing NPS? So I think he
I
is
think
asking
yes,
about
correct.
making some more voluntary contributions. Yes.
Yeah. So the voluntary contributions won't be tax exempt if you are
Hmm.
beyond the limits which we just discussed, correct? The voluntary
Hmm.
contributions by
Yes.
itself will not be, so there'll be no tax hack around it, but it will be a good
Yes.
savings opportunity, a good investment opportunity with a long-term
Hmm.
retirement
Hmm.
benefit and all that, to convert it into annuity and at the age of 60 and when you retire and all of that.
Right.
But yes, voluntary contributions are allowed.
Correct. Absolutely. Voluntary contributions are allowed. So there is no upper limit in making a voluntary contribution, but there is a capping on the tax benefit. So if you are
Yeah.
looking at just making investments for long term, and since it is at a very, very low cost, as low as 0.01%, if you are looking at making investments, yes, there is no upper cap in making investments in NPS. But there is a capping on the tax benefit. So with this,
And
we
I
come to
believe
Mr. Nirbhay Singh.
sorry, just to
I'm
ask,
so
add
sorry.
one
I'm
thing.
so sorry, Amit. Yeah.
Yeah, and the voluntary contributions, if I'm not wrong, can be withdrawn completely, and is can be withdrawn completely, though it will be taxable, correct? At a certain point in time.
Uh, we can withdraw 25% of the voluntary contribution, and that will be exempted from tax. We can withdraw
Hmm.
60% of the entire corpus, which is going to be a mix of voluntary contribution as
Oh,
well as employer contribution at the time of maturity, which will again be exempted from tax.
okay, and the rest, whether it's voluntary or whatever, will go towards the annuity.
Yes,
Yeah,
purchase of an annuity, which would give you a monthly pension or
yeah,
monthly half yearly, the way you decide.
yeah. Okay, yeah.
Yes.
Let's go to the next question. Yeah.
Yeah, a question from Mr. Nirbhay Singh. If anyone has opted for new tax regime, is he eligible for tax benefits of NPS?
Yes, I'd mentioned that under 80cc D2, the
Hmm.
employer contribution is eligible. But from what I recall, I don't think the other benefits are available. You can correct me if I'm wrong, Pratibha, but from whatever I could gather, 80cc D2 is available under the new tax regime. The 7.5 lakh we were talking about, but
Yes.
not the other. The 80cc D1 and 1B is not available. Um,
Yes. Yes. Absolutely correct, Amit. Only the contribution from the employer to an extent of 7,50,000 under ATCCD1. Only that one is given a place in the new tax regime. Other than that, none of the NPS options are exempted.
80cc D2. Yeah, 80cc
Yes,
D2.
correct.
Yeah,
Yes. So with this, I'll take a couple of few more questions because we are almost exceeding the time. So
yeah,
I'll take a couple of last questions.
yeah.
For NPS, does it depend on the employer whether they do a employer contribution or can it be done by HDFC Securities itself?
employer contribution has to be made by the employer. The employer has to agree because it will be part of your CTC. That's what we just discussed, the cost to
Hmm.
company.
Hmm.
So instead of
Hmm.
paying that money to you, the
Hmm.
employer has to agree to contribute it as an employer contribution to the NPS.
Hmm.
Correct, Pratibha? So I don't think
Yes. Yes.
HDFC, what you do through HDFC would be a voluntary contribution.
Voluntary
It will,
contribution.
yeah,
Yes.
it will not be, the employer contribution cannot happen through HDFC. HDFC can be the fund manager, the pension fund manager, the PFM,
Yes.
but it
Yes.
cannot be the employer until and unless you're employed by HDFCs.
Absolutely correct. Bang on. So
Yeah.
you can do your voluntary contributions through HDFC Securities. You can do your you can put in a standing instruction in your account through HDFC
Yeah.
Securities, but employer contribution in NPS works very similar to that of your Provident Fund, employer contribution towards Provident Fund. So that has to be routed through your employer only. And with this, I come to the last question of our workshop today. A question from Mr. Manoharan. He is asking, does VPF contribution fall under EPF interest rate?
VPF, oh, he's talking about the voluntary provident fund.
Yes.
The interest rate remains the same, if I'm not wrong. I think the interest is the same, and even the interest remains exempt. I think that's why people contribute more than the limit. So the interest remains exempt,
Right.
and so I think that's the only thing is when you invest that money, there is no tax benefit on VPF.
Hmm.
If it's
Hmm.
beyond the 1.5 lakh, correct? It's only that
Correct.
only up to 1.5 lakh under ATC, you will get the tax benefit the time of investment into VPF or EPF. Interest remains exempt. I don't think there is any way the PF office has got the method of differentiating what's the statutory and what's the voluntary. I don't think they differentiate that.
Yes.
The
Yes.
interest remains
Absolutely.
exempt. You agree?
Yes,
Agree,
it
Pratibha?
remains exempt. Yes. No, I was saying that, you are absolutely right on the VPF piece. It doesn't give you anything different than EPF. So,
Yep.
with this, Amit, we come to an end of our workshop today. Thank you so
Great.
much for joining in. And this was a quite an insightful session today. And I'm sure
Yep.
our audience have liked it a lot. And
Yep.
thank you so much for coming in. And we look forward to having you more on the future workshops as well.
Thank you for inviting me. Thank you, Pratibha, and thank you, HDFC Securities. And thank you, everyone, for your time. Thank you.
Thank you so much.